Hi, what's going on? It's Matt here, and I'm with Ron Milner. He is the founder of GoBoodle, the co-founder of GoBoodle with a partner. And when I met you at one of the events of Score.
Correct.
Yeah, and I got to talking with him about investing because I was really interested in investing, and I thought that his story was really, really compelling, and the way that he went about finding and learning investing on his own, and kind of helping out other people with the same kind of problem and helping them with kind of moving them in the right direction in terms of investments. So, without further ado, I just want to introduce Ron Milner and kind of let him take on this and tell the story with his own words. I think your story is very awesome. So
Okay.
start with
Well,
that.
okay. So the way I got into investing was by mistake, and my story actually started about 18 years ago. My mother, who was 67 at the time, contracted lung cancer, and before she passed away, she asked me to take care of her business affairs, which I agreed to do. So in July of 1998, my mother passed away, and out of her account, once I took care of the arrangements for the funeral, I received a check for $25,000. At that point in my life, I had never seen a check that big before. So my first inclination was to either buy a brand new car or take a trip. And finally, I decided on investing the money in the stock market. At that point in my life, I couldn't even tell you what a stock really was. So I went to a well-known bank and I met a financial advisor, and I told him what I wanted to do, which was invest in the stock market. And he gave me about 5 different brochures, and he asked me to take them home and study them and come back and tell him what I wanted to invest the money in. So I took them home, but I didn't really study them. I looked at them and I basically chose my investments based on their names, like blue chip or growth aggressive. So when I went back, I gave him my check for $25,000 in July of 1998. 3 months later, in October, I received my first statement back. And when I opened it up, I was shocked. My $25,000 was now worth about $13,000 in 3 months. My first reaction was I literally want to kill my financial advisor, but I couldn't because, you can't murder someone. So
Yeah.
I decided to face the truth and realize that it wasn't my investment advisor's fault that I lost that money, it was my fault. So I decided to go to my local library. I lived in Elgin, Illinois at the time, and I went to the library and asked the librarian to show me books on investing. And she said, okay, I'll be right back. So she went into the back area and she came back with a stack of books, about 15 books. And when I saw that stack of books, my first reaction was take the loss, take the $12,000 loss, and forget about it. But something forced me to learn about investing. So I decided to read those books, and I did. And after a period of time, about 3 or 4 weeks, the first thing I discovered when I read those books was that the very first thing that happened to my money when I turned it over to my financial advisor, he got paid right off the top. That was the first thing that happened to my money. The second thing that happened to my investment was he put me in the worst possible investments you could put a person in. As I'm reading these books at the library, I'm starting to gather all this information. And so I asked myself, why would he put me in the worst possible investments? And the reason was he made a bigger commission off of that money. So instantly, I lost about $12,000. So over the next year, 1999, I'm reading books, I'm watching financial shows, and I'm learning. And I decided to delete all of the investments that he had put me in and purchase my own investments. And once you sell an investment at a loss, you've lost the money. It's not coming back. So I had to accept that loss, that $12,000 loss. But in exchange for that loss, what I actually received was something much greater than the $12,000. I received a financial education because in 1999, that 1 year in my investments, I made about $100,000.
Yeah.
And at that point in my life, I had never made that kind of money before. I couldn't believe it. And I made the connection that the more I learned about investing, the more my money grew. So over that period of time, friends, coworkers, and family members would come to me and say, Ron, I have an investment. I don't know what I'm doing. Can you help me? And I would look at it and I would tell them what to do. And so they would do it, and 6 months later they would come back to me and they would shake my hand. I'm like, why are you shaking my hand? And they said, well, you helped me out 6 months ago, and look how much money I made. And they said, you know what, you should really do this for a living. I said, no, it's too much work, it's too much trouble. I like doing it for fun. So about 5 years or so ago, I met my partner. Her name is Peggy, and she said that we should go into business together. So we knocked around some names of different industries we wanted to get into, but nothing really stuck. So finally she said, well, what are you good at? I said, well, I'm good at investing. I said, well, what are you good at? She said, well, I'm a graphic designer. So we put our talents together and we created our company, which is called Boodle, Boodle. And Boodle is a members-only website that's dedicated to helping the average person learn how to invest for themselves and become their own personal money manager. What I've discovered in the years since starting Boodle and starting investing is the average person knows nothing about investing. It really is a world unto itself. And if you don't take the time to learn that world, it will pass you by. Just yesterday, the Dow Jones Industrial Average hit 24,000, which it had never done before. Mm-hmm. The market has gained in the past year $6.1 trillion. To the average person, the market going to 24,000 on the Dow, it means nothing to them because they don't have a direct connection to that. To me, it means a lot because I do have that connection. So I created Boodle to help the average person learn how to invest for themselves and to understand these concepts. Because once you get the basics down on investing, the rest is pretty easy. And since I started reading about investing in 1998, I have not missed a week of learning about investing. I'm literally doing homework every day of my life for the past 18 years because you can never learn enough about investing because it's a whole nother world. So what I've discovered is the two components I feel were key to my success was you have to have discipline because you have to be willing to stick with a process for a long period of time, and you must be curious. Curiosity literally led me to become successful in investing. And once you put those two dynamics together, the money will start to come to you. Because another thing that I've learned over these 18 years is people know how to repel money, they don't know how to attract it. Mm-hmm. Perhaps the most successful investor in history is Warren Buffett.
Yeah,
and he's
Charlotte Munger, yeah.
Yeah, he's worth about $86 billion. And Warren Buffett is about 85 years old or so. And last year alone, he made about $12 billion. Mm. And the reason he made that money is he's not out there working 24/7 like we are, though he is, but he's learned how to attract the money to him and it comes to him.
Yeah, most definitely.
Yeah.
So one of the things that I guess everybody's really concerned about, because you talk about curiosity, usually the curiosity goes the other direction, where they're like, okay, the stock market, they hear the stock market, they know about the past with, the housing market bubble and then all that kind of stuff collapsed. And so everybody's really, really risk adverse. Mm-hmm. And so everybody's thinking that, okay, when they hear the stock market, they automatically just turn off. And they're like, oh, that's really risky. Whereas I know that you have a different viewpoint on it. I know that with your type of investing, you're a lot more risk adverse, and you actually talk about like the different elements of risk that there are with investing in the stock market specifically.
Yes. Good point. There are actually 5 risks, and I've discovered this. It's like I said, it took me years to learn these concepts and these principles, but over time and observing the market, I've learned to adapt these principles and to I can expound on them. There are 5 risks when it comes to investing. The first risk is individual security risk, where you buy one individual stock and you put all your money in it. That's putting all your eggs in one basket. That's the first risk. The second risk is style shift risk, where if you put all your money into technology stocks or if you put all your money into energy stocks, that way your money is being determined by that particular sector. So if energy is out of favor, your money is out of favor. The third risk is the risk of being in the market. And what that risk is by having your money in the stock market, you automatically are subjected to whatever the market's going to do. But that's a risk that can be mitigated. A fourth risk is the risk of, I'm drawing a blank here because there are five risks.
I got you.
Individual security risk, stock market risk, manager risk.
Yeah.
When you buy a mutual fund, you have a manager who's managing that money, and he's purchasing stocks, he's buying them, and he's selling them. Well, if he's very successful one year, that doesn't mean he's going to be successful the next year.
Yeah.
So at Boodle, what we've learned to do is to eliminate four of those risks, and we assign a percentage to each of those risks. So each risk is worth 20%, and a total of 100. So we've eliminated 80% of the risk, and it leaves us with one risk, and that risk is just being in the market. That's the one risk you can't mitigate. But what you can do, if you find yourself with just that one risk of being in the market, you can get that risk down even further by putting your money into different assets like bonds or cash. And some people use gold, although we're not big proponents of gold. We don't really like gold. But we get that risk down, and once I learned how these concepts can be applied to a portfolio, I really haven't lost any money. We've had two downturns since 2000.
Mm-hmm.
We had the dot-com debacle in the year 2000, where we lost about 50% of our money, not us, but the market in general. And we had the housing crisis, which you referred to, in 2008, where another 50% was lost. And to put that in dollar terms, each time we had a downturn in the market, we lost about $6 trillion. So that's $12 trillion total. Now at Boodle, our philosophy is if some person or some entity or some group can lose that kind of money, we'd rather manage our own money ourselves. I don't need a financial advisor telling me not to pull out of the market. Now you have to remember that the reason they tell you to keep your money in, and the reason people lose that money, is because they don't want you jumping in and out of the market. Now, if I were a client at a financial firm and I want to pull my money out, he's going to encourage me to keep my money in. He won't call you up and say, you know what, you need to get out of the market because we think the market's going to turn down. Because if that financial advisor told you that information, he's got to share it with everyone, and they're not going to do that. So they're going to make you stay in the market whether you want to take that 40 or 50% hit or not. At Boodle, what we've done is we've identified times in the market when it's time to take money aside and put it in something safe like a money market account or even cash. So far we haven't had to make that call just yet, but we did it back in 2000 when the market turned. And you have to remember, back then I had only been in the market for about a year and a half. So when I got that signal to sell, I didn't believe it, because I said I just got in the market and I just made $100,000. How can I just pull this money out? And so I learned the lesson that when I get a signal to get out of the market, I take that signal. Mm-hmm. Conversely, when I get a signal to get into the market, I'm in. Now, the signal came to get in the market in March of 2003, March 11th to be exact. And that was the day that the United States got into a war with Iraq. That's the day the war started. And we were in a recession and we were coming out of it. My signal told me to get into the market. So I was telling everyone that I knew that that was the time to get in. And we made all our money back and then some. And the second signal in 2008, to be honest, I didn't really get that signal. I stayed in the market, but once I didn't get the signal to get out, I did get a signal to just stay the course, and the market was going to turn, and it did. And so technically, I didn't really lose any money because I didn't pull any money out. These signals are very hard to call. They're called bull markets when the market's rising 20% or more, and they're called bear markets when the market's going down 20% or more. Going up and calling the market at the top is very difficult to do. Calling tops in the markets, it's not easy. Yeah. Calling a bottom is easy because there are signals that tell you the bottom has just hit. And usually what happens is the stock market will go down. Let's say it goes down like 40%, and then one day it may go down another 200 points. And what it does is the market tests the bottom to see if there's a firm floor in there. And we watch for that test in the market. We're watching the market daily, And once we see that second bottom that's been put in, that's our signal to tell our clients that, you know what, the market's turned and we're now bullish. So in our point of view of the market today, we're very bullish on the market right now. We have some great signals that we've been paying close attention to. We watch economic indicators like the unemployment rate. We watch what the Fed's doing with interest rates. Are they raising rates? Are they going to lower rates? We watch like housing starts, the automobile industry, and we see where the trend is. Now, right now, the Fed's going to be raising rates. We think they're going to raise rates by the end of the year, probably around December the 30th or so, that the rates are going to go up. But we don't think that that's going to cripple this bull market. And the reason is that the Congress is about to pass a tax cut on corporations and individuals. We think that that tax cut is going to outweigh any interest rate hike. And the interest rate hike we actually see as a positive because that means that the market, the economy is growing. So we're very bullish on that. And we don't anticipate any downturns coming up in the foreseeable future.
Okay. Sorry to cut you off.
No,
I was going on in the market, which is interesting. But there's some other points I wanted to get through. Also, I made a point, Khan Academy, they have some really good, like, they have a series of videos that talk about, like, the economy crash and talking about, how that actually, went down. I definitely recommend them.
Mm-hmm.
But I wanted to get into the types of accounts, because one thing that kind of stood out to me was when we were talking about, the different ways you can invest,
Mm-hmm.
is the different accounts. Because if you have your money into like a regular IRA and you have $1 million, you're like, no, you don't have $1 million. You have like, whatever tax it takes out. So you have like $700,000.
Correct.
Yeah. And so I wanted to kind of ask you, like, what is a general kind of strategy for people in terms of like what kind of results they want to get and what kind of account that they want to use in order to get there?
That's a good, excellent question. And I think it depends on your age and your ability to stomach risk. And so you have to weigh those on your own. Now, I'll use my daughter as an example. I have a daughter who's 17 and she just got her first job. And so she got a 401k plan, which is a retirement plan. And she said, Dad, can you help me? I said, sure, I can help you with this. So we set up her 401k plan. I showed her how to pick the individual mutual funds to go into that plan, and she's going to be very successful. Now, at her age, there are things in life that she may want to purchase in like 5 or 10 years. So what I would suggest for someone like that, a young person, is to open up a 401k plan if you have a job. Second thing you might want to do, if you have any extra funds, is to find a brokerage account. Now, you can open up a brokerage account if you're over 18. If you're under 18, you have one of your parents assist you with that. But if you're over 18, you can open up that account. And by opening up a brokerage account, what you can do is you can put either stocks or mutual funds or any type of security into a brokerage account. And this is in a taxable account so that when you pull that money out, you will be taxed on that money. Now, what you would want to use that account for instance, say you want to purchase a home, you want to buy a townhouse or a condominium, you can use that account to fund that purchase that you want to make. Then you'll have your 401k plan for the long-term plan of retiring. Then you can also open up an IRA account. You can open up, there are two types of IRA accounts. There's the traditional IRA account, and there is a Roth, R-O-T-H account, Roth, which is named after the senator from the state of Delaware, William Roth. And the Roth account is what we really stress at Boodle because that account allows you to put money away. You won't get a tax break in the year you put that money in like a traditional account. The traditional account, you will get a tax break based on how much money you put away. With the Roth, you won't get that. But when you get ready to pull the money out of the Roth, it comes out tax-free, which goes to your point earlier. If you had a Roth and it had $1 million in it after 20 years or so, and I had a traditional and I had $1 million in it, when I start taking my money out, I'm going to be taxed at ordinary income tax rates, which will be about 31 to 35%. So I'm going to lose $350,000 of that money. By you being in a Roth, the money comes out tax-free. So you never have to worry about paying taxes on it. And it also has other benefits as well. You can pass that money on to a spouse or a sibling, and it can grow in their lifetime tax-free. So to me, there are a lot of benefits to the Roth, and I really
I didn't know that, actually.
like them. Yeah.
That's pretty good. Also, another point, I started work at PHP, and there's an analogy that this guy made is that between an IRA and a Roth IRA is that you can think of you going to buy seed so you can plant for the next harvest that you're going to have. And so at the farmer's market, the person says, oh, I won't tax you for the seed. I'll just tax you later when you're, after your crop. It's like, well, what do you want to be taxed? Like on the seed when it's like, $10 when you buy the seed, or when you have like, thousands of dollars in your crop, which one do you want to be taxed on? So just kind of a good analogy that I thought was pretty good. So I guess there's a lot that we talked about here, going on to like 20 minutes here. But I wanted to close out with talking about like your site and what you provide for your clients that you have.
Okay, great question. At Boodle, what we do is we made it for the individual person who doesn't really understand investing, but they know that they really should have some money put away. And on our site, we have individual membership for $99 a year. So you sign up for $99, and what that $99 does for you is it gives you access to the members-only portion of our website. So what you're getting is a direct connection to me and our strategy on what the market's doing and why it's doing. When $6 trillion, now think about that number for a second, when $6 trillion is lost, that's a lot of money. And that means that there are people literally that are either holding on or trying to get out of the market, and they don't know what they're doing. So at Boodle, what we do is we put out a signal. When we feel that there's a tremendous change about to occur in the market, we will let our members know through our website that our strategy has changed. This is what we're doing with our funds, and we leave it up to the individual to decide to follow us or to keep their money where it is. The website is a financial educational website so that you can learn at your own pace all about investing. We put information onto that site that I would want to know about if I were an investor. And I've been doing this for 18 years. Mm-hmm. You could literally learn everything you need to know about investing just on the Boodle.com site.
Nice. Yeah.
And that site's www.goboodle.com.
Okay. Yeah, and I'll put a link somewhere below for that.
Mm-hmm.
So that's that. I know you got a great blog. I tend to go on that sometimes and look at it. You got some pretty interesting viewpoints. I like it. So with that said, I hope you guys enjoyed this. If you have any questions, reach out to me, reach out to Ron, and yeah, that's about it.
Great.
Yeah, thanks for joining me.
Thank you.
Yeah.